All right. Keenan Hauke is from Samex Partners out in Indiana, but it's great to have him in New York, where he's all week long. You can see him on the opening bell with Alexis, and we're glad to have him here on Fox Business Live. Welcome, Keenan.
Absolutely. Thank you. I love this new format. This has got huge potential, Connell.
That's right. So you said the right thing, just like we talked about that script I gave you to read before you came on. Thanks for hitting that.
He's the one.
That's right. The check's in the mail. Let me hit the topic that I know you want to talk about and make people aware of, because, again, as we said, you were on Open Bell, and you and I talked about it a little bit this morning.
Right.
Volume, and some people kind of glance over that. They're more likely to say, "Oh, the Dow's down 50, or it's 100, or we were down 200 almost yesterday."
That's right.
You're very concerned about volume. You've been talking about it for a long time. Tell people why they should look at it also.
Yeah, because every time they open a newspaper or they're looking at the major news headlines, either the television, internet, or what have you, they see price. They see the Dow Jones up or down. That's a price indicator, and that is critically important. But volume kind of plays the role of the fuel that drives the vehicle up and down the road. And if we're doing a down move, let's say the markets have been generally trending down for 3 or 4 months, you notice at the end of the move, volume is getting smaller and smaller. Less people participating, less people are angry or willing to sell. A reversal could be at hand. The same is true of the upside. Look last year. It does help for people who are paying attention to this broadcast have access to any type of a chart, whether it's a chart that they get on a Yahoo site or something that they're doing from another source. Look at a chart. Actually pay attention to what is going on volume-wise inside of the stock market itself. Using the S&P, last year we had a great rally from the early March until early June of 2008. And yet from the beginning to the end, volume tapered lower and lower and lower. That was telling us that sometime in the near future, we're going to get a reversal. And by September, we were skating down to treacherous low levels. The volume since May 8th of this year, the market has been going higher.
We're showing a chart, Keenan, and I think it's the one that you had sent out earlier. It's showing it for our viewers to take a look at on the screen now. The live chat, those that are watching us live here at foxbusiness.com can take a look at this and bring it up. And Keenan, well, you don't have a laptop in front of you, but this is what what viewers have a chance to see, and you know what the chart says.
Exactly.
Tell them what they should see in that particular chart.
If you go ahead and look at the market put a high in on May 8th.
Right.
This was S&P 930. And it took a period of time, about 3 weeks, where it was generally lower to sideways, and then it started making higher levels. We saw 940, 945, 956 actually was the high print of last week. And yet look at the volume. You can see right here from May 8th until yesterday.
The bottom of the best thing to do, by the way, if you're looking at the charts, is hit the little plus sign to make it much bigger. Again, if you're watching live, and you can bring it up on the screen and follow along with what Keenan's saying.
Right. In May 8th, we have a high print of the S&P 500, but since then, the volume trend has been lower and lower and lower. And this is truly disconcerting because typically we come into the summer, volume can stay normal on a 12-month average until July, mid-late July. By August, it starts to disappear because people take vacations. What we're showing is volume trends that look almost summer-like in our fashion.
Like it's the middle of August. Like
and yet people who are saying things that I hear, S&P is going to be at 1,200 by October, Dow's going to be at 11,000 and 12,000, I say, show it to me.
Right.
Where's the gas in the tank?
So
if you're going to do that high, if you're going to see a higher price like that, you better refuel soon because there's no fuel left to drive this market higher.
Tom from North Carolina has an interesting comment. He said, sorry, Keenan, we now have a lost generation of investors. Volume definition has changed forever.
Well, that sounds a little Star Trek in implications, but I need a little more meat on the definition of what he's trying to say. I can see the fact. The fact is the market is higher for the past 6, 7 weeks, and the fact is the volume is lower. This is not a good sign if you want the market to go higher for the next several months.
John in Virginia, one of our other viewers, says, "Isn't this a bearish divergence?" So is this what we're looking at? That's what exactly your point then.
Yes.
This
is a negative divergence. Now, there are a lot of indicators, short-term and intermediate-term, Colin, that we can bring about, and it's a little difficult to put these on the internet site, but that show negative divergences. In other words, the market went higher and the indicator didn't go quite as high, but volume is a very easy one, and, in my opinion, it's the most important one.
So you don't think there's anything to this rally? That's the point.
I believe that by September, October, we don't have to go to a fresh low, but between middle of July to October, we're going to see some strong selling pressures that can come into the market, and I think it's going to take a lot of people by surprise. The volume picture, I think, is leading us down that path.
So now that we have been tipped off to it, how do we make sure that we make a portfolio as such to insulate ourselves from that surprise?
That is absolutely critical, and this is where rubber meets the road. First of all, if you haven't already, be very careful with somewhat illiquid positions, small cap stocks, micro cap stocks. They've been getting more and more popular as this rally has gone higher and higher from March 9th. That's also very typical of the end stage of a rally. You start to capture in that speculative behavior. Ignore it. Walk away. Make sure anything that you're in you can get out of even if it's starting to sell down relatively quickly. Liquidity is going to be key and king for the next 4 or 5 months.
So you like Mario Gabelli, who's like, I like Johnson & Johnson. I like Johnson & Johnson for decades now. I mean, you're just looking at some of these kind of recessionary bunker plays?
Well,
like
not necessarily recessionary.
Gamble,
I think you can stay with some technology plays. You could probably stay with some tech plays for a little while still. China looks good. But again, set the more liquid ideas that by July or August, when things really start to get dicey, you can get out of them. Be very careful about that type of situation. And also, don't be 100% invested right now. I mean, the market is going, most likely, in my opinion, it's going to get better pricing in the coming 3 and 4 or 5 month period of time. So pare back your exposure. Start to sell some winners and wait.
You've been largely negative in terms of your outlook on the economy and the market for a long time. But how have you played it in between then? I mean, did you crush by this rally, for example, when we ran up? Or
no, actually, here are the facts. On September 26, 2007, 2 weeks before the all-time high in the stock market, we moved our retirement portfolios to 90% in cash.
Oh, my gosh.
January 3rd of 2008, the other 10% went to cash. They stayed that way until March 16th, 2009.
Did you guys go out for a couple months?
Then they went 25% in, and we just took them out a couple weeks ago. In the fund that with the private fund that we operate, we covered all of our short positions by the 3rd week of February, and we started to experiment with some long positions by late March, semiconductors, some other technology plays, China stocks. Then we've been moving into more commodity plays.
You're mostly
week.
Okay. So that sounds, if that's true, that's like pretty good timing.
Wait a minute,
you're
yeah,
out completely, or no?
The retirement portfolios are 100% cash.
100%
Our private fund that we've been operating for almost 10 years right now is roughly 20 to 22% net long positions. Are a little bit of technology still. No more semiconductors, particularly. We got rid of those plays, and we're still in gold. We're still in natural gas. In the commodity plays, and China.
Wait a minute. So you must have been, did you have like a little office party after that? Were you so relieved after that? I mean, basically, on what did you see
Last
then?
year was tremendously positive for our firm.
Well, what did you see? What did you see on the horizon that you just, this
a lot of
rally's not, like this rally which is on fragile...
Exactly right. A lot of longer-term indicators were negatively diverging with the stock market, but over a multi-month period of time, the bull market started October of 2002. They last typically 4 years. That's the average going back up 100 years of data. So by early mid-07, your alarm bells automatically should be up. Hey, when's it going to end? We've been here 4.5 years. It should end soon. That's number one. And then you start to notice, oh, look at that negative divergence. Look at this one. Look at that one. You know what? It's September. The leaves are starting to turn. Winter's going to come soon. I know it. Let's get the coat out of the closet. Maybe I don't need it today, but let's at least bring it out and get it ready to be worn. That's what we started preparing ourselves by in August and September, and like I said.
Okay, so where do we go from here? If you, Seifi, is that right now? You better be right about the future. Put you on the spot. So we're in an environment in which you think is going to be inflationary.
Hold on. All right, I'm ready.
You think it's an inflationary environment. Not tomorrow.
Exactly right. I think long-term inflation is going to be a problem, and you hear some wild ideas out there. There is a Barron's Roundtable member, Mark Faber, who works out of Hong Kong, who has labeled it
boom and gloom.
Okay, yep. He's labeled it Zimbabwe-style inflation within 10 years or less. So maybe not tomorrow, even 2 years. But that sounds like something that's beyond my pay grade. I just know that over the next 10 years, inflation is going to become more of a problem than it is today. And
not
more
a couple thousand%, like whatever it is in
your
Zimbabwe.
cash. So
Right.
then how do you, so
That's right
first
now.
of all, explain cash. I mean, just
Money market funds.
Okay.
Go
So then
high.
if inflation is on the horizon, even in that time frame,
Right.
do you want to be in cash?
Well, that's why we have the gold. As we mentioned, we keep the gold around. And I think you can hold gold for 5, 6, 7, 8 year period of time in lieu of what's going to be coming. Does it go to $10,000 or $20,000 an ounce? I doubt it. But it can protect you, and it can still maintain some purchasing power for you.
Real quick, some of our viewers have been weighing in on what's going on in North Korea, paying attention to that, saying by July 4th or over the next several weeks, we're going to hear more from North Korea. Any type of that sort of news do you take into consideration?
No, I don't kind of close your ears for this.
Okay, I don't listen to you anyway.
I don't. Good point. I don't listen to the news. I don't read the news.
Except for FoxBusiness.com.
For this new show, he loves this show.
No radio, TV, anything. I look at charts. I look